So there's one question around what you were doing in the first 10 years of investing, when I think you averaged 40 to 50% annual gains after fees. If correct me if I'm wrong. What was the strategy that you and Rob Goldstein were following in those days, and what parts of that are actionable for the individual investor compared to the index plus strategy?
Sure. So stock investing is figuring out what a business is worth and paying less. And so that hasn't changed. What makes a company worth something and what makes it cheap relative to that? It's pretty straightforward. We're sort of, that's sort of Ben Graham. Figure out what it's worth, pay a lot less, leave a large margin of safety between those two. Warren Buffett added a little twist that made him one of the richest people in the world. He simply said, if you can buy a good business cheap, even better. If you read through Buffett's letters, it's very clear what he's looking for. First thing he's looking for anyway is businesses that are in high returns. We call it on tangible capital. And that just means every business needs working capital. Every business needs fixed assets. How well does it convert its working capital and fixed assets into earnings? So the example I used in the little book, which I really wrote to explain these kind of concepts to my kids, I said, imagine you're building a store, and you have to buy the land, build the store, set up the display, stock it with inventory, and all that costs you $400,000. And every year, the store spins out $200,000 in profits. That's a 50% return on tangible capital. Maybe I should open more stores. Not so many places I can reinvest my money at those rates. Then I compared it to another store. Remember, I wrote this for my kids, and I called that store Just Broccoli. It's a store that just sells broccoli, and it's not a very good idea. Unfortunately, still have to buy the land, build the store, set up the display, stock it with inventory. That's still going to cost you roughly $400,000. But because it's kind of a stupid idea just to sell broccoli in your store, maybe it only earns $10,000 a year. That's a 2.5% return on tangible capital. And all I'd simply say is I'd much prefer to own the business that can reinvest its money, all things being equal, much prefer to own the business that can reinvest its money at high rates of return than much lower rates of return. And so that's sort of the Buffett twist that we incorporate in the companies that we invest in by being very tough on the way companies earn and spend their money. So we tend to get a group of companies that are not only cheap, but also deploy capital well. And that's really what we're looking for. So we've always done that. The little book was more of a way to systematize that. But You Can Be a Stock Market Genius, which, what did we do in the first 10 years? I wrote a book about it. It was You Can Be a Stock Market Genius. It was looking for off the beaten path, more complicated, things that other people weren't looking at. Something strange or different was going on. I showed people nooks and crannies in the market where they could look for those. The issue there, and there is no issue, it's a great business, but our portfolios were 6 or 8 names. We're 80% of our portfolio. We returned half our capital, outside capital, after 5 years. We returned all our outside capital after 10 years, between 85 and 94. We were lucky enough to have enough money to keep our staff and continue to run our money thereafter. Warren Buffett said a fat wallet's the enemy of high investment returns. And so when you have a very concentrated portfolio and you're looking off the beaten path where there are kind of smaller situations and things that are more obscure, you're very liquidity constrained. That's why we kept returning money. But that's not why we're doing what we're doing now. If you're going to run other people's money, this is what I'll tell you with a portfolio that has 6 or 8 names that are 80% of your portfolio. Every 2 to 3 years, usually within 2, Rob and I, my partner Rob Goldstein and I, would wake up and we'd find out we just lost 20 or 30% of our net worth. And that happened like clockwork every 2-3 years. Just always happened. It has to happen with a concentrated portfolio, either because we were wrong on 1 or 2 of our picks, or market, they were out of favor for some period of time, and maybe it bothered us, maybe it didn't, if we just had to be patient. But I would say for outside, when I was talking about people going in and out of funds and losing the return, that is not conducive for other people, especially if they're not doing the work. It was okay for us, and I think it was good for us because we knew what we owned. And so as long as the facts hadn't changed and as long as we believed in our thesis, we could take that. I wouldn't say it was easy, but we could take that. Now, our bad days, we have hundreds of stocks on the long side and hundreds of stocks on the short side. We're trying to be right on average. We're buying cheap, good companies. We're shorting companies that are either destroying capital or losing money or whatever it is. And over time, that pays off. But our bad days with hundreds of stocks on the side are 20 or 30 basis points of underperformance, not 20 or 30% of our net worth. And so I think for most people, it's a smoother ride. And one of the great lessons that young investors, and a lot of you guys are still very young, can learn are the compound interest tables. You know, if you can make mid-teen returns, we wouldn't make 40 or 50% annualized returns, but in mid-teens returns, if you know compound interest tables, you could do very well over, you know, with a smoother ride over a long period of time. One of the best examples, and when I taught those ninth graders, I actually put on the outside of their notebooks, I handed them notebooks, and on the outside I had a compound interest table, and it had the example of starting investing $2,000 a year when you're 19, you know, in your IRA until you're 26. So 7 years of putting away $2,000 and never putting another nickel in again. Or starting when you're 26 and putting in $2,000 a year for 40 years until you're 65. So the people who put in $2,000 a year from age 19 to 26 and never put in another nickel ended up with more money. If you earn 10% a year on that money, they ended up with more money with those 7 payments than the people who started 26 and put in 40 payments till they were 65. You end up with more money, the 19 to 26. Just a very important lesson to learn about starting early. I know all of you are over 19, so I'm sorry I didn't tell you this. but these kids weren't. And so compound interest tables are important. So you're young. If you stay with a very methodical investment strategy that makes sense over time, you can all still do very, very well.